So you've got a big responsibility, $250 billion, 750,000 people depending on this. We've got firemen, policemen, teachers for their pensions. Tell us about the investment climate as you see it today. It's a bit different than it was just 2 or 3 years ago, given where we are with interest rates, inflation, growth.
Yeah, well, David, I think it's going to be another challenging year in 2023 for the U.S. economy and financial markets. As a long-term investor, we tend to look less at the short-term fluctuations in asset prices. We have diversified portfolios that actually are geared to weather all different markets. My hope and expectation is for the global economy to, for growth to bottom out this year and inflation start to decline more meaningfully. We have inflation coming down in the States, less so in Europe at this point. There's a lot of things to consider out there. We look at the risk of a recession here and abroad. We're coming off of one of the most aggressive interest rate hike cycles that we've seen by the Fed in 40 years. You know that monetary policy operates with a long and variable lag. So we really haven't seen the impact of those rate hikes yet. And those rate hikes continue. The Fed hiked 25 basis points earlier this month. They've hinted that they're probably going to do another 2. And that's what Fed fund futures are pricing in. We also, as I said, inflation abroad is still sticky on the upside. I also think there's a heightened level of geopolitical risk to consider. The war, the Russian invasion of Ukraine is problematic. We worry about that escalating. And I do think from a longer term perspective, the dynamic between the U.S. and China and the relationship, I think will have implications for growth, competition, asset allocation for years to come.
So, Stephen, you have the luxury of a long-term perspective. On the other hand, you have to have the money when the pensioners need the money, as a practical matter. You have to generate returns. 2022, as you say, was a rough year. We had stocks and bonds both down, as a practical matter. What does that tell you as an asset allocator about stocks, bonds, and maybe the alternative to the above?
So stock and bonds, it's rare that they go down in tandem, but it's not unprecedented. And you're right, David, last year was a tough year. We had that traditional 60-40 equity fixed income bond split generated a negative return of 16%. That's painful for all manner of investor. We do, again, look on a long-term horizon. We want that balanced portfolio. But you're absolutely right. We had the offset, if you will, of private assets. We have about a 22% allocation into private assets, spanning private equity, private credit, infrastructure, core, non-core real estate, as well as hedge funds. So we do have those offsets that can help drive that performance, irrespective of what happens in the public markets.
You said 22%. You've had a cap of 25%, as I understand it. That's now been raised to 35% by the governor, Kathy Hochul. Do you expect to use a lot of that increased cap?
Well, that's a wonderful question. So, the new legislation was signed into law by the governor at the end of the year, and it definitely will give us an expanded opportunity set. We'll be able to have a more optimal portfolio. My expectation is, we're going to start the process of reviewing our strategic asset allocations with the 5 plan trustees and their consultants. Hoping to wrap that work up by, say, October, and then perhaps if there is a change in strategy, that'll be implemented in 2024 and beyond.
Besides the liquidity issue, what about the transparency issue? Because when you have marketable securities, you know what their value is reasonably. With a lot of the private assets, we're not so sure. I mean, do you mark to market, for example, your investments?
We do mark to market. We rely on the general partners that we choose to work with to mark the positions to market. Those marks tend to be pretty conservative, so when equity markets are rallying, say in private equity, those marks aren't quite as high as the public markets go. Similarly, on the downside, they're not less likely to decline as much as public markets. So we do that. That's a great question. You do worry about transparency, the opaqueness. It's also less regulated, although I know that the SEC and others are taking a closer look at it. We try to focus on picking those high-performance, high-conviction managers that can perform over time. So given our size and our footprint in the market, we really have a wonderful opportunity to deal with the biggest and the best that are out there.